So let us start with another scenario of double A. The following scenario relates to question 66 to 70. It is 1st July 2005. You are an audit manager in All and Co responsible for the audit of Hawk Company. Hawk Company manufactures kites which sells its via its website directly to customers. You are currently planning the audit for the year ending 31st July 2005. Two issues have been brought to your attention during the planning meeting with the finance director. Okay, and what are those? Let us look at them now. The financial controller of Hawk Company, who had been employed by the company for over 20 years, was dismissed in May 2005. Okay, a claim for unfair dismissal has just been received. No replacement has been found for the financial controller as of yet, and the tasks are being shared between the finance team until the role is filled. Okay, the payable ledger supervisor left in March 2005, and a replacement has only been appointed in the last week. However, for this period, no supplier statement reconciliation for trade payables, reconciliations were performed. The finance directors has also provided you with the most recent management accounts to enable you to perform preliminary analytical procedures, and you have calculated following ratios: gross profit margin, payables payment period, receivables collection period. So, which of the following are appropriate auditor response to the increased audit risk created by the finance team being allocated the work of the financial controller? So, audit team should be fully briefed and the alert throughout the audit for additional errors. Okay, not a correct option. Option two. Auditor should appoint an expert to properly assess the risk of misstatement. Option two is right over here. The finance director should be requested to provide the audit team with assistance for the matters that cannot be addressed by the remaining finance function. Right. And the last option. Uh, so option three is the right here and not option two. I'm sorry for that. So there is no suggestion of any issue that would cause the auditor to consider resigning. This audit team should be fully briefed and advised to be vigilant. The finance director should also be advised that their assistance is likely to be requested by the audit team in the absence of a financial controller. So 66 for 66, the third option is absolutely fine. Then we have next option. Okay, which three of the following statements are true in relation to the lack of supplier statement reconciliations? Now, the auditor should perform the supplier statement reconciliations for Hawk Company. Okay, no, there is an increased risk of misstatement of trade payables, right? Misstatements in the purchase accrual balance may go undetected. Yes, and the auditor will need to send the request for confirmation of balances to suppliers. No, and increased substantive tenses testing will need to be performed over purchases and payables. Yes, this is the right answer. So, lack of supplier statement reconciliations can mean misstatements within payables and accruals go undetected as controls are not effective in this area. Increased substantive substantive testing will need to be performed. The auditor should not perform the reconciliations as this is the responsibility of Hawk. There is no need to send requests for confirmation if the client has received a supplier statement. The issues relates to the client not reconciling the statement to its own ledger. So 67, here we go. Next question. In respect of the unfair dismissal claim, which of the following audit procedures is not appropriate? Review correspondence with the financial controller and the company, no. Review board meetings minutes, no. Review correspondence between the company and its lawyer. Discuss the claim with the financial controller is not appropriate in this case, because it would be appropriate or professional for the auditor to discuss the claim with the financial controller, especially when legal proceedings are ongoing. Okay, so it would not be appropriate for the or professional for the auditor to discuss such claims with the financial controller. Next, which audit risk can be identified from the preliminary analytical procedures performed? Gross profit margin, website sales may not be accurately recorded. Payables may not be accurately recorded. Extended credit terms may have been given to the customers. So, well, it cannot, A cannot. B, revenue may have been recognized too early in GP margin. Suppliers may be withdrawing credit terms. Receivables may not be completely recorded. No. C, revenue may not have been occurred. Purchase invoices may have been recorded twice. No. Receivables may not exist. No. Website sales may not be completely recorded. Payables may not be completely recorded. Receivables may be overvalued. So D is the correct option over here. The for gross profit margin, the ratio has decreased from 26 to 17%, which indicates website sales may not be completely recorded. So if sales had not occurred, the revenue balance would be overstated and the gross profit margin would increase. If revenue had been recognized too early, the revenue balance would be overstated and the gross profit margin would increase. For the payables payment period, the ratio has decreased from 75 to 40 days, which indicates understatement of payables. That is, payables may not be completely recorded. Suppliers withdrawing credit terms is a business risk, not an audit risk. And if purchase invoices have been recorded twice, the payables balance would be overstated and the payables payment period would increase. Okay. And the finally, receivables collection period, the ratio has increased from 29 to 38 days, which indicates receivables may be overvalued. Extended credit terms may have been given to customers is not an audit risk. If receivables are not completely recorded, receivables balance would be understated and the receivables collection period would decrease. So D is the right option in this case. And now finally, we have last question in this scenario, that is question number 70. Okay, and which of the following are reasons why analytical procedures will be performed during the planning of our company? To help identify area of potential risk, to help obtain an understanding of our company, to help detect material misstatements in the financial statement figures. And for me, option 2, 1 and 2 is the right one over here, as the analytical procedures are being performed at the planning stage using the most recent management accounts of our company. The financial statement figures are not being tested. Analytical procedures at the planning stage are performed to help identify areas of potential risk, obtain an understanding of the client. The draft financial statement figures are available. Substantive analytical procedures can be used to help detect material misstatements. There we go. So I hope it is clear till here, and we are done with this scenario as well. So far, so good.